put the posting. Yeah? We have the vouchers and we also have the receipts. Okay. What's your opinion? Remember, when you are posting for TOT, okay, you are going to post meets. In other words, segment.
Okay. When we talk of share-based payment is where is a transaction in which an entity will receive goods or service from other parties, such as suppliers and employees, but the consideration will be the equity instrument of the entity. You buy goods or you receive service, but in return, you are going to give shares of the company. Then we say that there are three types of share-based payment. Number one, we say we have equity settled. Number one, we have equity settled. Number two, we have cash settled. Then number three, we have choice between equity and cash. You can either, the counterparty has a choice either to be compensated in equity or cash. It is called choice settlement. The counterparty can choose either to be compensated in equity or cash. These are the major three types of share-based payment. And we say that under equity settled, the entity is going to receive goods or service from other parties, but the consideration will be equity instruments, including ordinary shares. Consideration will be the equity instruments, including ordinary shares. Then under cash settled, we say that an entity will receive goods or service from other parties such as suppliers, but the consideration will be cash. Consideration will be in cash, but the cash will be based on the equity instrument. The cash will be based on the equity instrument of the entity. Therefore, you receive cash, but it's not just a normal cash. The cash will be based on the fair value of the equity instrument. Then the choice between equity and cash, this is where an entity will receive goods or service, but now the consideration will be a choice. You either choose to be paid in cash or to be paid in equity. That is choice settlement. Then we say that this transaction, share-based, mostly it is used under employee share option, under employee share options, where the employees are given privileges to get the shares of the company. Employees are given the rights or privileges or the freedom to get the shares of the company. Therefore, under employee share option, what the examiner will require you, the objective of this standard or the objective of this employee share options is how to account for the expenses and the liabilities that will arise from this transaction. How are you going to account for this employee share option? Like I was giving you an example in the previous class that, for example, you have 200 employees, then the option per the rights, the privileges you are giving is 100. Then the fair value of the shares is 10. The fair value of the shares is 10. Therefore, it means that the company is going to pay 200,000 to these employees. 200,000. But we said that, remember, a company will use these employee share options or these privileges to motivate employees to stay in the company as a motivation to the employees to stay in the company for a longer period of time. Then, for example, we are in the year 2020, then you tell employees that if you will be in the company in the year 2023, you will have to get our shares for free. Therefore, this period that you are giving the employees, the period that you are giving the employees to stay in the company for them to receive shares is called vesting period. Vesting period. The period that you are promising the employees that if you will be in the company from year 2020 up to year 2023, you will get shares is called vesting period. And we say that there will be conditions that will be attached. Any condition that will be attached, we call it vesting condition. Vesting condition. We say something on vesting condition. Vesting condition. Therefore, we say that vesting condition, these are the conditions that and the counterparty must satisfy before it becomes entitled to equity instrument. The conditions that you must meet before you become entitled to equity instrument. And we said there are two types of vesting condition. We have what we call service condition, and performance condition, condition. We say that service condition, you are required to give a specified service level. For example, you are required to serve the company for the next 10 years, next 30 years, before you qualify to receive this equity instrument. That is service condition. You are required to achieve a specified service level. Then performance condition means you are required to achieve a specified performance level. Like, for example, you are required to achieve 90% profitability. 90% profitability. If you are required to achieve 90% profitability, then the moment you achieve, you qualify for the shares. We say it's a performance condition. And under this performance condition, we still have other two conditions there. We still have under this, we still have what we call non-market condition and market condition, non-market condition and market condition under performance. Market condition, this deals with it deals with profitability of the company and the EPS, earnings per share of the company. But market condition, this deals with the market price per share, MPS. It deals with the market price per share of the company. Market condition deals with the market price. When I say profitability and market price, what do I mean? I mean this way. For example, you are in a company, like where you are working currently, then the company promises you that we want to give you shares. If, for example, our profit increases from 200 to 300, we shall give you shares in the company. That's a performance condition. And under that performance condition, it's a non-market condition because non-market deals with the profitability of the company. But if, for example, the company tells you that if our market price per share, that is, moves from shillings 20 to 25 or 30, then we shall give you share. That is a market condition. Then listen to this carefully. Market condition is not binding. Market condition is not binding because an employee has no control over the market price of a company. Like, for example, when you go to Safaricom, currently Safaricom is trading at about 13 or 14 there. Therefore, an employee has no control over that price. Therefore, that is not binding. But non-market condition, it is binding. Therefore, if you are calculating the expense or the liability, non-market condition must be considered. Non-market condition must be considered. Let me read your charts. Mwalimu quiz, Florence, I said you don't ask for permission, you just type the question. Does it mean market condition deals with EPS and profitability of the company? Does it mean that market condition? No, non-market, this is non-market condition is the one that deals with profitability and EPS. Market condition deals with market price per share of the company. Market price per share. Non-market, I am confusing the two. We have two, non-market and market. Now, Florence, listen. Non-market and market. Non-market deals with profitability and EPS, earnings per share of the company. When we go to market condition, it deals with the market price per share. Market price per share. Like what I'm telling you, what is the market price per share of Safaricom? It's around 13 or 14 there. Therefore, if we have that condition, then we check. For example, the examiner, the company tells us, if it will move to 20, then I will give you shares. Therefore, that is the market price per share, that is the market condition. But profitability and EPS, that is non-market. Also, this service condition. Now, let me bring back here. Also, this service condition is a non-market condition. Service condition because you are required to be in the company for a specified period of time. Therefore, that is also a non-market condition because it's not dealing with any market somewhere. Therefore, service condition is the perfect example of non-market condition. But when we come to the non-market condition itself, the standard gives us the profitability and the earnings per share of the company. Earnings per share of the company. I believe that confusion has been sorted. Now you will not confuse yourself anymore. And we also mentioned that the day when the counterparty is promised these shares, for example, I'm promising you shares on 21st January 2020 to 1st in 2023. This January 1st, 2020, we call it the grant debt. Grant debt, we say that is the debt when the counterparty, enters into agreement. The debt when the entity and the counterparty enters into agreement. We call it the grant debt. We call it the grant debt. Now, let me show you, improve this topic. Let's improve the topic as we move on. Let's improve on it. Now we know what are the conditions, vesting condition, what are the vesting debt, blah, 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 blah. Therefore, here, I say that the employee, we have 200 employees. The options are 100. The fair value is 10. Therefore, here, we shall be paying 200 like this. But remember, here we have, for example, the company has promised the vesting period is 3 years. 3 years is the vesting period. Vesting period is 3 years. Vesting period is 3 years. Therefore, the company is required to recognize this expense or liability in the financial statement for the 3-year period. Therefore, how do we recognize? In year 1, I will take 200 times 100 times 10 times 1/3, the vesting 1/3. When I come to year 2, I will take 200 times 100 times 10 times 2/3. I get cumulative liability there. In year 3, I will take 200 times 100 times 10 times 3/3. Now, this is where I'm going to pay 200,000 because those who are in the company are vested. When you vest, you get your entitlement. Therefore, in year 3, remember in year 1, I'm just recognizing an expense and a liability that is arising from this program. Now, let me develop this again. Now, remember, not all employees will be loyal to the company. Not all employees will be loyal to the company. Therefore, if any employee leave, then you will not qualify. If any employee leave the company before the vesting period, then you will not qualify. Like here, let's assume in year 1, 10 employees leave. In year 2, 15 employees leave. 15 employees. In year 3, let me say 20 employees leave. Therefore, when I'm calculating this expense, in year 1, I will take 200 minus 10 times 100 times 10 times 1/3 because 10 employees left. The moment you leave, you cease, you forfeit your rights. Well, then in year 2, Now we know that 10 employees left. In year 2, I have 190 minus 15 times 100 times 10 times 2 over 3. Now 15 have left, 10 left in year 1. When I come to year 3, I have now here 175 minus 20 times 100 times 10 times 3 over 3. Therefore, these are the ones that will vest. These are the ones that will vest. Those are the ones that will get those rights to the shares of the company. Those who have vested. Those are the ones that will be paid. Those are the ones that will receive the shares of the company. Therefore, if you leave because you are not meeting the service condition, for example, you automatically forfeit the shares. You automatically forfeit the shares there. Now, listen carefully here. Because of this turnover of employees, because employees will always leave the company. Therefore, listen to this, is very critical. Now, let me pause before I explain because it's very critical. Let me pause before I explain because it's very critical. Now, let me explain. Because of this turnover of employees, the company will be using what we call the best estimate in the market of the employees that will be leaving the company. The company will be using the best estimate. Like, for example, here, you can see 10 employees left. When we come to year 2, 15 employees left. When we come to year 3, 20 employees left. But remember, in year 1, we are recognizing an expense there. We are recognizing, I believe my good friend Waziri is around. We are recognizing an expense. Therefore, the company will be using what we call the best estimate of the supposed employees leaving the company. Like, for example, in year 1 here, maybe 10 employees left, 10 employees left, but now we know very well that in year 2 and 3, maybe some other employees will leave. We know very well that some other, of course, the employees will leave. Therefore, I'm in year 1, then I say 10 employees left. But I expect that 20 employees will leave in year 2. Listen very carefully there. I expect that 20 employees will leave in year 2. Then when I come to year 2, you'll find that 15 employees left. Therefore, I expected that 20 employees will leave, but 15 are the ones leaving. Then when I'm in year 2, I expect that 25 employees will leave in year 3. Therefore, if I'm computing this expense, I can see Wasiri is around. In year 1, I will say 200 minus 10, those who left. But remember, I still have the expectation, the estimate that in year 2, 20 employees will leave. 20 employees will leave. Therefore, here I'm going to put the estimate of the employees who are leaving in year 2, as I estimate that 20 employees will leave. And then I multiply by 100, I multiply by 10, I multiply by 1 over 3 there. I multiply by 1 over 3 there. I multiply by 1 over 3. Then when I come to year 2, 15 employees leave. Therefore, here, 20 was an estimate. Listen very carefully. 20 was an estimate, but the exact number of employees who left were 10. Therefore, when I come to year 2, I have 190 employees. Now, when I was in year 1, I expected that 20 will leave. But when I come here, I find that only 15 leaves. Therefore, I come to subtract 15, like that. Then, in the same year 2, I'm expecting that in year 3, 25 will leave. 25 will leave. Therefore, I subtract the estimate of 25 times 100 times 10 times 2 over 3. I said this is critical. You need to listen very carefully. Then, when I was in year 2, I expected that 25 employees will live in year 3. But when we come to year 3, I'm finding that only 20 employees will leave the company. Therefore, here, in year 3, I will take 175 minus 20 times 100 times 10 times 3 over 3. Now, why am I using the estimate? Like in year 1, I use the estimate of 20 of year 2. When I come to year 2, I use the estimate of year 3. This is to harmonize the expense that I'm going to recognize in year 1. I just want to harmonize so that I don't over-report the expense. Because, of course, in subsequent years, I expect that employees will be leaving the company. Therefore, if I don't use the estimate, then it means that in year 1, I will over-report the expense. But when I come to year 3, because of course employees are leaving, I'm paying less. In year 3, I'm paying less. But in year 1, I over-recognize the expense because of the employees' turnover. Therefore, sometimes we are going to use the estimates to perfect our financial statement so that we don't over-recognize the expense in year 1. We don't over-recognize the expense in year 2. So in year 3, we are paying less. Therefore, the company will be using the estimate. Therefore, what I'm saying here, if I'm in year 1, then I have the estimate of year 2 that maybe I expect that in year 2, these employees will leave. In year 1, I'm going to include that estimate. Then when I come to year 2, I estimated 20 will leave. How many have left? 15 left. But I estimated 20. Therefore, I was not badly off. I was around the corner there. Although I missed a point by 5, but I was around there. When I come to year 2, I estimated that in year 3, 25 will leave. But when I come to year 3, 20 left. Therefore, I was also around the corner. I was not badly off. Therefore, it means that in year 1, I did not overstate the expense by including too many employees. But of course, they will leave the company. When I come to year 2, I did not overstate the number of employees because, of course, I estimated 25 will leave, but 20 left in year 3. Therefore, we harmonized at least what we are going to recognize in the financial statement there. We are going to harmonize what we recognize in the financial statement there. Now, let's use an example. Or before we go to an example, or let's first use an example. It will be prudent. First, we use an example. And the example we are going to use is AKAST 2023. AKAST 2023, question number AKAST 2023, question number 4. Question number 4. AKAST, let's use an example so that we understand what I'm saying. AKAST 2023, question number 4, as we move on. AKAST, if you are there, kindly you tell Marimu yes, so that we move together. If you are there, just be kind to Marimu, you say yes, quickly. Our time is running out, kindly. Our time is running out. We need to utilize what we have at hand. Anyone who has found AKAST 2023, question number 4? I just need one person to say yes, I'm there. Just type Y. Thank you very much, Jen. You are there. Now, because Jen is there, let's continue. This question number 4B A1 says, with reference to International Financial Reporting Standard IFRS 2 share-based payment and citing examples, explain the impact of non-market condition, market-based performance condition on accounting for an equity settled share-based payment transactions. With reference to International Financial Reporting Standard IFRS 2 share-based payments and citing examples, explain the impact of non-market performance condition on accounting for an equity settled share-based payment transaction. Now, the impact of non-market condition is that they must be considered when accounting for the expense or liability. That is the impact. They must be included. They must be included in accounting for the expense or liability. The impact is they must be considered. Example of that, we can say service condition. We can say profitability of the company, earnings per share of the company. But the major impact is when you are calculating the expense or the liability, you must consider, you must include the non-market condition. Because like here what I'm saying, if the employee leave, then he will forfeit. He will not qualify for the share-based transaction. That is a non-market condition. If you leave, you don't get anything. Therefore, we must consider you there or you are not there. That's why you are going forward even to do the estimate of those who will leave. Therefore, non-market condition must be considered when computing the expense or liability. Number two there, on 1st January 2020, Dabora Limited granted each of its 180 employees 1,000 share options. These options will vest if the employees remained in the employment of the company until that 1st December 2022. On the grant date, the fair value of the option was shillings 15 each. 25 employees left the company during the year ended at 1st December 2020, and a further 30 employees were expected to leave in each of the 2 years, that 1st December 2021 and that 1st December 2022. During the year ended that 1st December 2021 and that 1st December 2022, 20 employees and 18 employees terminated their employment contract respectively. Required, show the extracts of financial statement for Dabora Limited for each of the 3 years ended that 1st December 2020, 2021, and 2022. Therefore, the vesting period in this question, it is 3 years. The vesting period is 3 years. Therefore, we are going to recognize this for the next 3 years. Florence, you are saying, Jen, tuma picha kwa group, see the quiz. Kindly make sure that you have these questions. Remember, we posted the questions from 2023 December up to 2015. Therefore, you can save them, you can print them for easy access in classes. You can do them for easy access. You can sacrifice a little bit, or you can just use a soft copy if you are an expert. But if I were you, for comfortability, I can just print them. I can just print them, and so that I don't get any inconvenience when I want to revise or when we are in class, because in class, Marim will be picking any question. Marim will be picking any question. Remember, we don't plan any question. We just see, let me do this. It's relevant at this point. It helps you understand the concept, therefore. And these are the only questions we are going to use, KASNEB questions. Therefore, make sure my advice is make sure you have the question papers with you so that you don't get any inconvenience. You understand the concept as it comes. Now, let's say here we say we want to do the question of August 2023. We say here, computation of the expense, computation of expense. Then we are going to recognize the expense itself. We are going to recognize the liability like that. We recognize the expense, then we recognize the liability. Expense and the liability. Now we are in year 2020, that's our year 1, 2020. Year 1, that is 2020. The examiner says, on 1st January 2020, that is our grant date. That's an on grant date, Dabota Limited, granted each of its 180 employees. Therefore, so we have 180 employees in this company. This company is a very big company. It has 180 employees, 1,000 shares or share options. These options will vest if the employees remained in the employment of the company until that 1st December 2022. On the grant date, the fair value of the shares was 15 each. 25 employees left the company during the year 2020. Therefore, out of 180, 25 employees left the company. Therefore, they will not vest. And 30 employees were expected to live in each of the 2 years, that 1st December 2021 and 2022. Now we are in year 1. Listen very carefully what I was explaining. This is the confusing part. We are in year 1, but the company tells you that we expect that in each of the 2 years, in 2021, we expect that 30 employees will leave. 2022, we expect that 30 employees will leave because it is in each of the 2 years, in each. Therefore, here I'm going to subtract 30. I also subtract what? 30 because I'm in year 1, but I'm estimating that in year 2022, 2021, 30 employees will leave. In year 2022, 30 employees will leave. Therefore, those estimates, I'm going to include them in year 1. I'm going to include them in year 1. Then I multiply by the options, which is 1,000. I multiply by the fair value, then by 1/3. I take the portion, I amortize that expense for year 1. Therefore, who can give us the liability and expense for year 1? And kindly, I said, you give an answer before your neighbor. That is the spirit of ever. You give an answer always before your neighbor. That is 180 minus I'm getting 475. Thank you very much. 475,000. 475,000. Like that. 475,000. 475,000. 475,000. Getting 470. Remember, the option are 1,000. 1,000 is the option. It's that. Why subtracting both years in the first year? Because I'm subtracting Waziri because the examiner said in each. What does in each means, Waziri? What does in each mean? In each means that in year 2021, that will live, year 2022, that will live in each. But if the examiner says, we expect that 30 employees will live for year 2021 and 2022, then we only take one. In years 2022 and 2021, we take one. But here, he's saying in each. Remember the English of in each. The English of in each of the 2 years, in each. Therefore, in each, it means in year 2022 and in year 2021, they will leave. Then we are recognizing the expense, we recognize the liability. Then I come to year 2, when I was in. I come to year 2. Now, when I come to year 2, I know very well that 25 employees left. Therefore, here, I'm going to take 180 minus 25. I get 155. Those who are there. Those who are there. Those who are there. Then they tell us that in that year, in the year 2, that is in the year 2021, 20 employees left. 20 employees left. Now we had estimated 30 employees, but now 20 employees left. 20. We had estimated 30 in year 2, but how many left? 20 left. Therefore, we are only going to include here the exact, which is 20. We estimated 30. I believe you are seeing here, we estimated 30, but when we came to year 2, you find that 20 left, 20 left, 20 left. Then we are in year 2. When we were in year 1, we estimated that in each year 2 and 3, 30 employees will leave. Therefore, we still have the estimate of year 3. This year 3 estimate is still available. The year 3 estimate is still available. Therefore, here, I'm going to subtract the 30. Why am I subtracting 30? My good friend Ruth, why am I subtracting 30? Because I'm in year 2, but remember my estimate of this 30, it will still hold the water. It means that I'm still expecting that in year 3, 30 employees will leave. 30 employees will leave. Therefore, I'm subtracting 30 here because of the estimate of year 3. I'm not yet there. I'm not yet in year 3. Then I multiply by 1,000. I multiply by 15. I multiply by 2 over 3 like that. Marim, where did you get 55? I got 55 because total employees were 180. Listen very carefully. Total employees were 180. In year 1, 25 employees left. 25 employees left. Therefore, if 25 employees left, it means I'm remaining with 155. Remember, these are the estimates. These two are the estimates. But those exactly who left are 25. Therefore, it's 180 minus 25 who left. 25 left. That's where I got 55. 155. Therefore, quickly give me that is 155 minus 25 minus 30. I'm getting 100 times 1,000 times 15 times 2 divided by 3. I'm getting, is it 1 million? 10. I can see 10, 105. 105, let me repeat mine. I'm getting 1050 like that. I'm getting 1050. Now 1050 is the cumulative liability. Remember here we have the expense and the liability. Therefore, this is the cumulative liability. Expense here, listen very carefully and you follow me steadily here so that you don't miss the point. Now my expense here will be the difference between the liability 1 here and liability 2. Remember, this is the increase in the provision for liabilities. In year one, my liability was 475. When I come to year two, my liability is increasing to 1050. Therefore, my expense here will be 1050 minus 475. I'm getting 575. Therefore, my expense here is 575,000 like that. My expense. My expense. Then I come to year three. Now, in year three, remember 20 employees left. 20 employees left in year two. Therefore, I'm only remaining with 135. 135 minus 18 employees who left in year three. Remember, when we were in year 1 and 2, we estimated that in year 3, 30 employees will leave. But when I go there, only 18 employees are leaving according to the exact statistics. Statistics is showing that only 18 employees left the company. Only 18 employees left the company. Then I multiply by 1,000. I multiply by 15 times 3 over 3 like that. Times 3 over 3. Then Mwalimu will do it. 135 minus 18. Mwalimu is getting 117 times 1,000 times equals to times 15. Mwalimu is getting 1755. 1,000 like that. Remember, you need to give an answer before Mwalimu and also before your neighbor. Year 3 does not have an estimate. Yes, Florence, in year 3 you cannot have the estimate because that is the final year. Those who are there are the ones that will vest, because remember, this one we are calculating at the end of the year, at the end of the year. Therefore, in year 3, you cannot have the estimate because that is the final year. You can no longer estimate anything because that is the final year. Check year 1. I am seeing an estimate of 30. Yes, there is an estimate of 30. There was 2 estimates. The estimate of year 2021 and the estimate of year 2022. There were, because examiner said, Ruth, listen, Florence, in each, what does the English of in each mean? In each means in year 2021, that will leave. In year 2022, that will leave. The English of what? In each. But if the examiner says, listen, if the examiner says the company estimates that 30 employees will leave in year 2 and 3, in year 2 and 3, listen very carefully, in year 2 and 3, then it means you subtract only once. If the examiner says the company estimates that 30 employees will leave in year 2 and 3, you subtract once. But if it is in each means in year 2021 and in year 2022, the English of in each means that here and here. Then here, let's get the expense here. Expense will be 1755 minus 1050. I'm getting 705. 705 as an expense there, 705. Then we are done. Now, these are the expenses the company is going to recognize, and these are the liabilities. Expenses and the liabilities. Now, how do we account for this expense? In year 1, I have the expense of 475. Therefore, I'm going to debit P and L with 475,000. I credit equity compensation, equity compensation with 475,000 like that, with 475, equity compensation with 475,000. We credit equity compensation. When I come to year 2, this is the expense in year 2. Therefore, I debit P and L with 575,000. I credit equity compensation with 575,000 like that. When I come to year 3, this is the expense. Therefore, in year 3, I'm going to debit P and L. To debit P and L means you are going to charge it to P and L as an expense. P and L, 7 or 5,000. I created equity compensation, 7 or 5,000. But remember, after I have recognized those expenses, this is what the company is going to pay. This is what the company is going to pay, 1755. Therefore, in year 3, there will be 2 journal entries. I'm going to debit equity compensation, 1755. I created ordinary shares. Ordinary share capital with 1755,000. 1755,000 there with 1575,000 there. 1575,000 there. Any questions so far? I can see from Edwin. Mariam, what is the relationship between liability in year 1 and in year 2 in relation to expenses in year 2 and 3? What is the, please explain the last entry. Waziri, Fahima, please explain the last entry. The last entry here, remember, let me start with the last entry. The last entry. Remember, the promise is that if you will be in the company, we shall pay you. Therefore, the moment you are in the company, these have qualified, have vested. Now we need to pay them. Therefore, we are debiting the equity compensation program. Then we credit ordinary shares. The company is going to issue ordinary shares to its employees. Why is year 3 appearing twice? Because in year 3, Ruth, we are first recognizing the expense to our P and L. This is an expense to the P and L. But now, this one, we are not recognizing the liability. This one we are paying. We are issuing shares. This one we are issuing shares. I'm showing you how we shall issue shares. The last entry, this one. Because those who are in the company have qualified, we call them have vested. Therefore, we are going to pay them. Then this is the expense. We are just recognizing the expense to our P and L. But this one is what the company now is paying out as the shares for those employees who have vested. Then somebody else asked, what is the relationship between the liability and this? Remember, in accounting, let me go back in accounting. In accounting, the increase in liability, when the liability increases in accounting, what is increasing the liability? Edwin, what is in the liability? What is increasing the liability? What is increasing the liability? What is increasing the liability is an expense. Like in year 1, remember this is a provision, a liability, it was 475. Then this 475, when we come to year 2, it is moving from 475 liability, it goes to 1050. Therefore, remember this is just a provision. It's just a provision. We are not paying the liability, it's a provision. Therefore, we are moving the liability from 475 to 1050. 475 to 1050. Then what is increasing this liability from 475 to 1050? It means there's an expense of 575. When I come to year 3, in year 2, this is what we have as the provision for liability. But now it's moving from 1050 to 1075. What is increasing it from 1050 to 17? It is the expense of 7 or 5. That's how you recognize that. Adjust your screen. We see the farthest part of the liability. Thank you very much. I adjusted already. Therefore, thank you very much. How did you get 7 or 5? That's what I'm explaining, Florence. I'm saying from 1050, this one, to 17, What is making it increase to 17? It is this 705. Therefore, you take this previous liability minus this liability. Therefore, you compare the two. From 1050, it's increasing to 1755. You get 705. And this second, you are moving from 475 to 1050. What is increasing? The expense, which is 575, this one. It is moving from this to this, we get this one. The last one is moving from this to this, we get this one. That is what is increasing. And how did you get 175? It's not 175, it is 1755. 1755, just go to our computation kindly. Go to our computation, you get it. That one, I'm not going to do it, Florence. Go to computation because it means you are not doing it. If you do it, you will get that one. Go to computation, you will find that 1755. When you do this one, you get it. Okay, let's move further. And develop this concept. Let's move further and develop this concept. Again, we are still developing the concept. Therefore, you need to be keen, because if anything will pass you, then it will be very difficult to understand it. Therefore, make sure that you stay with us, you follow very keenly here, and you become attentive, and you also participate by giving answers. Because if you just sit there, then it will be very difficult for you to understand. But if you participate, like my good friend Florence is participating a lot, it means you will understand a lot. But if you just see and keep quiet, you might at some point find it difficult to get it. Where does 475 go to? This 475, it is an expense. This one is a liability, goes to the balance sheet. This one goes to the P&L. This one goes to the balance sheet. In year 2, 575, this one, I believe you are seeing my hand, 575 goes to the P&L. This one goes to the balance sheet. This one goes to the balance sheet as a liability. It goes to the balance sheet as a liability. Then in year 2, in year 3, this one goes to the P&L, but this one, because they have vested, we are paying them, they shall not recognize the expense. So when making payment in the final year, you debit equity and credit P&L. No. Mwalimu did not write P&L. Mwalimu said credit ordinary share capital. I said credit ordinary share capital. You are issuing shares. Kindly, Florence. I said in year 3. I wrote here, let me repeat where I wrote in year 3. I said you debit equity compensation. Kindly just follow what Marie is doing. 1755. Then you credit ordinary. I said ordinary shares, ordinary share capital. Ordinary share capital with 1755. Because at that point, we are issuing shares. there. Just follow what Marie is doing so that we don't waste time repeating a lot of things here. We don't waste time repeating because we shall not move and we are behind. Remember, we missed almost 4 classes. Therefore, if we don't move with speed, we shall not make it. And we want to make it at some point. Therefore, let's develop this concept further. I believe you are attentive now. Let's develop the concept further. Now, we said that we have 3 types of share-based. Listen very carefully. We have 3 types of share-based. We have equity, compensation. We have cash. Then we have choice. Choice between equity and cash. We have choice between equity and cash. Now listen. When I'm calculating the expense under equity, listen very carefully. When I'm calculating the expense under equity, I will only use one fair value. Use the fair value on grant debt. When you are calculating the expense under equity settled, listen very carefully. because this is also very critical. Itakuwa inakuchanganya at some point. It is very critical, so you better listen. I'm saying, when I'm calculating the expense like this one under equity settled, I will use the fair value on granted. Therefore, it means that when I'm calculating the expense under equity, I will only use one fair value. Like here, you can see here, I used 15, I used 15, I used 15. Listen very carefully, I used 15 all through. Although in this question, examiner gave me 15 only one. Therefore, I used 15 all through because it was the fair value on grant debt. It was the fair value on grant debt. But if I'm calculating the expense or liability under cash, we say you remeasure the fair value at each reporting date, and on settlement. At each reporting date and on settlement. At each reporting date and on settlement. That is very critical, very important, very important. Let me show you something. For example, I have 3 years. I have year 1, year 2, and year 3 there. Now, in year 1, examiner will give me the fair value as 20. Year 2, examiner will give me the fair value as 25. In year 3, the fair value is 30, for example. In year 3, the fair value is 30. The examiner tells me out of this that the fair value on grant debt, grant debt was 15. The fair value on grant debt was 15. I believe you are listening very carefully because we are developing this concept. The fair value on grant debt is 15. Therefore, if the question is equity settled, I will ignore all this and use the fair value on grant debt in each year. I will only use the fair value on grant debt. Use the fair value on grant debt for each year. Here I will use 15, here 15, here 15 in each year. If it is equity settled. But if it is cash settled, if the question is a cash settled, then it means that I will be using the fair value at the end of each year. Like for example here, examiner has given me at the end of year 1, I have 20, end of year 2, I have 25, end of year 3, I have 30. Therefore, in year 1, if it is a cash, I will use 20. In year 2, I will use 25. In year 3, I will use 30, which means I'm saying you remeasure the fair value at each reporting date and on settlement. You remeasure the fair value at each reporting date and on settlement. But if it is equity settled, then you are going to use the fair value on grant debt. We say to use the fair value on grant debt, and we say that the grant debt is the debt when the counterparty entered into agreement. We call it the grant debt, the debt when the counterparty entered into agreement. The debt when the counterparty entered into agreement. I believe that one is okay. Now, let me also develop this concept again. I believe you are keenly listening to this because it's very important. This one we have understood, but the choice, remember the choice will either be equity or cash. Therefore, it will be either, because the choice is either equity or cash. Therefore, it will be either. But the most sensitive is either equity or cash. The most sensitive is either equity or cash. Now, let me again develop this concept because of the questions. Let me develop the concept again. Now, how will you know that in this question, examiner wants equity? Examiner 1 is asking for the equity settled. How will you know that? How will you know that the examiner is asking equity settled? Here, the examiner will, in a question, tell you that the company granted share options, comma, share options, or option to purchase shares. You are granted share options or options to purchase shares. That is an equity settled. It means you are going to receive equity. You are going to receive shares. I believe up to there we are okay. If the examiner tells you the company granted share options to its employees or options to purchase shares, that is an equity settled because the employees, it means they will get shares. But if the examiner tells you now cash, let's move to cash. How will you know that this examiner wants a cash settled? The examiner will tell you that you are given cash awards. The employees were given cash awards. Cash awards or bonus in cash, bonus in cash, or share appreciation rights. You are given share appreciation rights. Share appreciation rights. You are given a share appreciation rights, we call it SAR, in bracket SAR, share appreciation rights. If you just find this one in a question like what you have read, examiner has said the employees were given cash awards. You remember the word is cash. Then the employees will receive cash. If it is bonus in cash, then the employees will receive cash. Or if it is share appreciation rights, SAR, and then it's also a cash award, which means we are going to use the fair value at the end of each period. At the end of each period. Thank you very much. Thank you very much. Thank you very much. Now we know if it's a cash or equity. If it's a cash or equity, like what we are given here, it was equity because it says on 1st January 2020, Tabora Limited granted each of its employees 1,000 share options. 180 share options. If it's share options, then it is equity settled. That's why we used the fair value on grant debt. That's why we use the fair value on grant debt. The fair value on grant debt. Now, let's look at one question as we move on. Let's look at one question, at least one question again as we move on. Let's go to the question of September 2021. Let's go to the question of September 2021 as we move on. September 2021. Let's move to the question of September. I believe you are moving with speed to look for that question of September 2021 or August. Some books will read August, others will read September. Therefore, you don't have to worry. September 2021. I believe question number 4 or 3. September 2021, quickly. September 2021, sorry. My name is already there. It is question number 3B. Question number 3B. Question number 3B. Not 4, 3B. Question number 3B. Quickly. If you are there, you say yes. And you can share because of our good friends maybe who are missing. If you have it already, you share. If you have it already, you share so that we can enjoy all of us. We can enjoy all of us in this. If you have it, you can share for your comrades. Move with speed. Thank you very much, Florence. You are saying, getting you, Maribu. Thank you very much. Waziri, you are saying Saudi Arabia imefanya nini tena? Now, I believe you guys are there. Therefore, let's move with speed. This question number B says, Peponi Limited decided to grant its 500 employees 200 share options each. Now, as you can see, we are granting them share options. Therefore, this is an equity settled because we gave them share option each from 1st July 2021 on condition that employees still be in employment or as at that of June 2025. Therefore, the vesting condition is that you must be in employment for the next 4 years. The company has provided the following regarding to the share option scheme. We have year ended, number of employees expected to leave the employment, fair value of each option. Then we have 2022, 2023, 2024, and 2025. The fair value of the option was 40 as at 1st July 2021. The exercise price of the option was shillings 15, and the par value of the company share was shillings 10. The average market price of the share over the 4-year period is expected to be 50. Required extracts from the financial statement of the Peponi Limited for each of the years ended 30th June 2022 up to 2025 to reflect the above transaction, 8 months. 8 months. Now here we are going to say here computation of expense. Then we report the expense as usual. Then we report the liability. We report the liability there. You will see the magic. We report the liability there. Here, our vesting period is 4 years. Vesting period is 4 years. Vesting period is 4 years. Now, in year 1, that is in year 2022, we have total number of employees is 500. Then examiner is saying in year 1, 40 employees were left. 40 employees. 40 employees left. Remember here, examiner is just giving us the number of employees expected to leave in each year. Now, in this such a scenario, listen very carefully. You should not confuse on this. Listen very carefully. Examiner is giving us the number of employees expected to live in each year. Like in year 1, it's giving us 40, year 2, 30, year 3, 25, year 4, 25. Therefore, in that regard, we are just going to treat them as the employees who left. It's not an estimate. Because it's in each year, it's not an estimate. Therefore, you treat them as employees who left. Like in year 1, 40 employees left. Then you multiply by 200. 200 is the options. Then you multiply by the fair value on granted. This is an equity settle. The examiner says, Apocini, the fair value of the option was 40 as at 1st July 2021. When we entered into contract, the fair value was 40. Now, as you can see, examiner has given us the fair value at each reporting date. But because this is an equity settled, we ignore all of them. We use the fair value on granted in each year. Then we multiply by 1/4 because the vesting period is 4 years. Vesting period is 4 years. Vesting period is 4 years. Then we quickly find that is 500 minus 14. I get 460 times 200 times 14. Whatever I get, I divide by 4. 920. I'm getting 920 there. 1,000. Therefore, the expense is also 920,000. 920,000. Thank you very much. 920. When I come to year 2, I have 460 because 40 left. Then the examiner tells me that how many employees left? That 30 employees left times 200 times 40, the fair value on granted, times 2 over 4, times 2 over 4 there, times 2 over 4 there. Therefore, I'm taking 430 times 200 times 14. Whatever I get, I multiply by 2. I divide by 3. I'm getting, what am I getting? That is 430 times 200 times 14 times 2 divided by 4. I'm getting 1720. My liability for year 2 is 1720, thousands like that. Liability for year 2 is 1720. 1720. Now, for me to get the expense here, listen, my good friend Ruth, the expense here, I'm going to compare them. From year 1, it was 920. It's moving to 17. It's a provision. Therefore, the difference will be an expense there. The difference will be an expense. As my good friend Ruth is saying, it will be 800. Thank you very much, my good friend Ruth there. Now you are talking now. You are taking the idea here. It's 800,000 as an expense. I come to year 3. Here I have already 430 minus 25 times 200 times 40 times 3 over 4 like that. 430, remember here, we have subtracted 30. Therefore, 460 minus this, I get 430. So I am asking a question, does the same apply for cash? Yes, it applies for cash, but in cash, I say, you change the fair value. If, for example, it was cash, then what do we do? If it was cash, then we were to use the fair value at each reporting date. Like in year 2, I would have used 35. In year 3, I used 30 like that. Then, Florence, you are saying you have a burning question. Therefore, let me unmute you and ask.
Mwalimu, thank you so much.
Yes.
Under cash,
Yes.
you stated that we will use different fair values, which is okay.
Yes.
So I'm asking, in year 1, we'll calculate the expense, which
Yes.
figures shall read the same.
Yes.
In year 2, which we are going to use a different fair value, are we going to treat it the same? Are they going to read the same value or a different value? That is what I'm asking.
They cannot read the same value if it is cash. Remember, because like for example, in year 1, I'm using 40. When I come to year 2, I will be using, for example, the fair value at that year is 30. The fair value is 30. Therefore, the figures cannot be like now here we used 40. The figures cannot be the same, but the reporting is the same. The only thing that is changing is the fair value, this one. That is the only thing that is changing. Otherwise, the computation, the number of employees living is the same. The only thing that is changing is the fair value at the end of each reporting date. Are you okay with that way? Florence, we are still with are you okay? Okay, I believe you are okay. Now, this is an equity settle. Therefore, we move with 40 in each reporting date there. Then, who can give us the expense for year 2, year 3, liability cumulative? Cumulative liability, that is 430 minus 25, I get 405 times 200 times 40 times 3 divided by 4. Thank you very much. 2430. Now, the difference between 17, these two, it will give us an expense. How much is an expense? How much is an expense? 710. Thank you very much. Then I come to year 4. That is my first year. I have 405 minus 25 times 200 times 40 times 4/4. 4/4 is just like times 1. Times 1. 4/4 is just like times 1. Then we see what we are going to report there. $30, $40. Thank you very much. $30, $40. Then what will be the expense? Expense. Thank you very much, Ruth, for supporting us. 610. Thank you very much for supporting us. As I said, you give your answer before your neighbor. You need to give an answer before your neighbor. Ruth is supporting us very much. Thank you very much. Be blessed. Now, this is the expense that the examiner will report on the financial statement. That is the expense. Then the liability will be in year 1, this one, year 2, this one, year 3. This is what we are going to pay because those who are in the company have vested. Therefore, that is we are going to pay 30, 40. Now, in year 3, in year 4, our journal entry will be debit, equity compensation with 30, 40. You credit ordinary shares, share capital with 30, 40 because you are issuing share capital there. You are issuing share capital there. Therefore, you debit equity compensation, you credit ordinary shares. But this is the expense you are going to recognize on the financial statement. You are going to recognize in the financial statement. Now, as you can see here, now I was saying the importance of an estimate. Listen very carefully. Now you can see in year 1, I'm recognizing an expense of 920. But when I come to the last year, the expense has reduced to 610 because a number of employees have already left. It's coming to 610. That's why we are saying the companies will use the best estimate so that they don't overstate like in this one. Because we did not apply the estimates, we have overstated like in year 1, we are reporting 920. Year 2, 800. Year 3, 710. In the last year is 610. We are overstating the expense in year 1. Therefore, if we use the best estimate in the market, then this problem will not arise. Remember, this is just the recognition of an expense provision. Therefore, we are overstating too much. We are reporting too much expense. And at the end, we shall pay very small amount. Therefore, the importance of estimate is to harmonize the income statement so that you don't over. Remember the impact of reporting too much expense. It means your profit will be very minimal. Therefore, we don't want to affect that because it has the impact on the company performance there. Therefore, that is what we can say there. Now, let me also develop the concept again. I believe my good friend Florence, you are around, so that I can also develop this concept again. This concept needs development now, and then as we conclude it, we need to develop it as we conclude, as we move it once in this phase. Now, what I want to explain now, what I want to explain here is very critical. Thank you very much. You are saying I'm here. Thank you very much for being here so that we explain together this concept. Now, here we have been using the figures of the employees who left. We have been using the figures here. At some point, examiner will give you the estimate in terms of percentages. The estimate of the employees who leave in terms of what? Percentages. In terms of percentages. Like for example, examiner will tell you scenario number one. Examiner will tell you scenario number 1. In terms of percentages, now, listen very carefully, it's very critical, very important. because you will find many questions have percentages and you wonder what will I do here. Therefore, this is what we will do. For example, in scenario number 1, examiner will tell you that the company had 1,000 employees. XYZ Limited granted its 1,000 employees, maybe blah, 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 share options, and the company estimate that 5% of the employees will leave for the 3-year period, The company estimates that 5% of the employees will leave for the 3-year period. We estimate that 5%. Then how am I going to calculate to incorporate it here? We estimate that 5%. In year 1, I will take 1,000 times 5% times 95% because I estimate that 5% left. Listen very carefully. Times the options, maybe 200. I'm assuming the options is 200. Times maybe the fair value, which is 40, times 1/3. We estimate that 5% of the employees will leave. When I come to year 2, remember this was an estimate of 5%. Therefore, still I will take 1,000 times 95% times 200 times 40 times 2/3. I believe now you know how to bold this part. It's not important to do it now. It's not important. When I come to year 3, I will still take 1,000 times 95% times 200 times 40 times 3/3. If, for example, examiner has told you that the company estimates that 5% of the employees will leave in the 3-year period. 5% of the employees will leave in 3-year period. Therefore, it means that 95 will remain. But remember, it's just an estimate, it's not actual. Examiner is saying we estimate that 5% of the employees will leave. Therefore, it's not actual. Therefore, this is how we handle. I believe that one has sunk. We go to another scenario where we use percentages. For example, in year 1, examiner will tell you that we estimate that 5% will leave. When we go to year 2, examiner tells you that the estimate was revised to 8%. The estimate was revised to 8%. What do? We are going to use 8%. When we go to year 3, the estimate was again revised to 6%. The estimate was revised to 6%. Mwalimu, you said year 3 we do not use estimate. Why? But remember, in terms of percentage, examiner told us that we estimate that 5% of the employees will leave. 5% of the employees. Therefore, if it's in terms of percentage, then it means that this percentage will apply all through. The percentage will apply all through. Year 1, we estimate that 5%. Year 2, we estimate that 5%. Year 3, we estimate 5%. Then we are going to use percentage all through like that if it is in terms of what? Percentage. Then here, I'm explaining here. Now, in year 1, we estimate that 5% of the employees will leave. When we come to year 2, then the examiner tells us that the estimate was revised. The estimate was revised to 8%. Then when we come to year 3, still examiner is telling us the estimate has been revised to 6%. Therefore, it means here, listen here, I'm coming to where you are. Here, I will use 95% as usual because 5%. When I come to year 2, I use 92% because it was revised to 95%. When I come to year 3, it becomes 94%. It was revised to 94%, to 6%. Therefore, we're going to use 94% here because of the revision. But if it is just for the 3-year period, that is what I explained in the first year. Now, let me come to you. I'm also concerned, my good friend Florence. We have a concern. What if they say 5% of employees will leave each year? I'm coming there. I'm coming there. Don't worry, Edwin. I'm coming there. I'm coming there. I'm coming there. Mwalimu, what is that 1,000? 1,000 is the number of employees. The company has 1,000 employees. Then we estimate that out of 1,000, we estimate that 5% will leave out of 1,000. Therefore, it is the number of employees. It is the number of employees there. Therefore, we estimate like that. What? We do not subtract. We do not subtract. Yes, we do not subtract. We do not subtract. Then let me also explain something. Let me also explain something. Let me also explain something which is very critical. Very critical. Let me explain something which is very critical here. Now, something I want to explain is that, for example, examiner will tell you that in year one, the company estimates that 5% of the employees leave the company. When we come to year two, then the examiner tells you that the estimate was revised to 8%. When we come to year three, then examiner tells you that from the human resource department, it showed that 5 employees left in year one, 8 employees left in year two, then 15 employees left in year three. Listen very carefully. I'm saying, for example, I'm in year one. Examiner tells me that 5%, we estimate that 5% of employees left the company. 5% of the employees left the company. When we come to year two, examiner tells us that the estimate was revised to 8%. But when we come to year three, examiner is telling us that from the human resource department, it showed that 5 employees left in year one, 8 employees left in year two, 15 employees left in year three. What do we do here? Let me show you what you do here. Let me show you what you do here. Now, in year one, I'm going to take 1,000 employees times 95% times 200 times 40 times 1/3. When I come to year two, I will take 1,000 times 95 times 200, times 92, because it was revised 92% times 200 times 40 times 2/3, times 2/3 like that. When I come to year three, now I will take 1,000 minus 5 minus 8 minus 15 times 200 times 40 times 3/3. Therefore, it means that the exact figure of employees who left will come in the last year. Exact figure of the employees who left will come in the last year. But in year one, we are going to put the estimate of 5%. In year two, we are going to put the estimate of 92%. When I come to the last year, I put the number of employees who left. The number of employees who left. I believe we are getting the idea as we move on. We are getting the idea as we move on. We are getting the idea as we move on. We are getting the idea as we move on. Why final 5 minus 8 minus 15? Because in year one, we were using the estimate of 5%, estimate of 8%. But when I come to year three, that is because that is the year of compensation. That is the year of compensation. That's why I'm putting the exact. That's why I'm putting the exact, because that is the year of compensation. I want to compensate, therefore, I'm going to take the exact figure of the employees who left. But here, I'm just estimating because examiner told me that we estimate that 5% will leave, 8% will leave. When we come to year 3, we find that we were given the exact figures. Therefore, we are going to subtract the exact figures in year 3 here. Use subtract the exact figures there. Sometimes again, I believe you are getting these things so that you will put them in questions. I will expect that you implement them in questions. Therefore, I believe you are getting it. Florence, you say you are crying here. Why are you crying? No, I must continue to finish. Let me finish the first one. You are saying to not continue. I must continue to finish the first one. Can you add 5 plus 8 plus 15? Yes, it's possible. If you want Waziri, you can add 5 plus 8 plus 15. You can add and subtract. You have a question? Yes, Florence. I said you should not ask for permission. Just ask. Unmute and ask. Florence, unmute and ask.
Okay, I've done so. Mwalimu, I have a question.
Yes.
The first one, you stated that 5% is the number of employees which shall be living for 3 years, which you calculated 95 all through.
Yes,
Then
yes.
I asked,
If the examiner says the company estimates that 5% of the employees will live for the 3-year period.
yes.
Yes.
So for this other one that we were given the different percentage, you calculated that other one for 92%, 95%.
Yes.
And there's another one, I don't know the last figure. Yes, 8, which was 90 whatever percent. Why are you?
Because the examiner was revising the estimate.
Or if the term revised used, now for the final year you have to subtract.
Now, remember, if it is just pure estimate, as I already said, for example, I have year 1, I have 1,000, I have 1,000, I have 1,000 employees. Then if the first examiner tells me that we expect 5% to leave, I said we shall use 95%. When we come to year 2, the estimate was revised to 8%, therefore I will use 92%. When I come to year 3, for example, the estimate was revised to 6%. Then I will use 94 because I expect that 6% left. Therefore, I will do like that.
Oh, so if they have different percentage figures, we use that one. But if it has one that is all through, I got the first way.
Yes, if, for example, examiner tells you that we estimate that 20% of the employees will leave for the 3 or 4 years period, then it means we will be constant. If it is 20% of the employees leave for the 3-year period, then here I will use 80%, 80%, 80%. If it is 20% of the employees will leave for the 3-year period,
Okay, understood, Mwalimu.
Next question, maybe. But as you can see, if, for example, the examiner has given us the actual in the last year, that is what we are going to put in the last year, the actual. You put the actual in the last year. Now, let me do the last one. Let me do the last one. Let me do the last one now. For example, the last one, examiner is very tricky. In the last one, examiner will tell you that the company estimates that 5% of the employees, 5% of the employees, 5% of the employees will leave the company. We leave the company per annum for the 3-year period, per annum for the 3-year period. The company estimates that 5% of the employees will leave the company per annum for the 3-year period. Therefore, if it is per annum for the 3-year period, when I'm in year 1 like this, I will take 1,000 times 95% times 95% times 95%. If it is per annum for the 3-year period, like my good friend Edwin was asking, for example, each. Therefore, in each is like this one, per annum for the 3-year period, per annum for the 3-year period. That is how you handle. When we come to year 2, for example, the examiner revises the estimate and says, we estimate that 8% of the employees will leave the company per annum for the 3-year period, per annum. Therefore, still I will take 1,000 times 92% times 92% times 92%. If it is per annum for the 3-year period. When I come to year 3, then also the examiner says that the company estimates that 4% or 6% of the employees will leave the company per annum for the 3-year period, per annum. Therefore, still I will take 1,000 times 94% times 94% times 94%. Then don't forget the other variables. Those are constant. There is no problem. Don't forget the other variables. Therefore, if the examiner says per annum, then for the 3-year period, then you are going to use 3-year period. If it is per annum for the 2-year period, you use twice. If it's per annum for the 3-year period or for the 2 years or the 4 years. If it is 4 years, you multiply 4 times. If it is 2 years, vesting period, you multiply 3 years. Therefore, that is how you are going to apply those estimates in terms of percentages and blah, 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 like that, blah, 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 like that. Therefore, let's look at one question, I believe. Let me look at the question of May 2017. I believe the question of May 2017, it has percentages, May 2017. Kindly move with speed, May 2017. Our time is running out, May 2017. Our time is running out, so you move with speed. We go to May 2017. May 2017. Question number 2. Question number 2C. Question number 2C. May 2017, question number 2C. May 2017, question number 2C. May 2017, question number 2C, I believe you are there, so that in interest of time, it says, on 1st January 2014, Commonwealth Limited issued 500 share options to each of its 1,000 employees eligible for employee share ownership scheme. The fair value of each option at the date of grant was 30. The options had a vesting period of 3 years, and any employee who resigned before that 1st December 2016 was not entitled to any shares. As at 1st January 2014, the management estimated that 5% of the employees would exit during the year. On 1st January 2015, the estimated number of employees who would resign was revised to 8%. Actual information from the Human Resource Department indicated that 24 employees exited during the year that first 2014, that first December 2014, 17 employees exited 2015, and 6% of the employees exited during the year 2016. Required journal entries to record the transaction with regard to the share options for each of the years ended that first December 2015, 2016, 2014, 2015, 2016. Then number 2, explain how your answer in C above would be different if the employees had an option to be paid in cash equivalent to their market price of the shares vested. Now let's move with speed to do this question. That is May 2017. Question 2C. We say here, computation of expense. Then we report expense. We report the liability. Expense and the liability there. Now, when I'm in year 1, I have Conway Limited has how many employees? It has 500. Share options with 1,000 employees. We have 1,000 employees. In year 1, we estimate that 5% will live there, will remain with 95%. Then times 500 share options, times 30, times 1/3 like that. Then you give me these 2 items. You give me those 2 items. Just like that. When we come to year 2, still we have 1,000. Then the estimate was revised to 8%. Therefore, it means I'm remaining with 92% here, times 500, times 30, times 2/3. I believe you know now how to report the other end. I believe you are experts to report the other end there. When I come to year 3, now there is actual information which shows that I have 1,000, 24 left, minus 17, minus 6. Those who left, the actual who left, times that 500, times 30, times 3/3. I believe you can give me those figures there, I believe you can give me the figures there. Then examiner wanted journal entries. Journal entries is where, for example, I have the expense, this one, I make a journal entry, debit, equity, debit P and L. That is in year 1 with this expense. Debit P and L, you credit equity compensation. Equity compensation. When in year 2, you debit P and L with the expense that will be there. I believe you can compute it. P and L with the expense, you credit equity compensation. In year 3, you are going to debit P and L with the expense that will be there. I believe you can now compute it. Then we credit equity compensation. Then still in year 3, we have 2 journal entries. In year 2, I believe you are not putting XX, you will be putting figures, expense here, the figures of expense here, the figures of expense there. In year 3, now what will be here in year 3? That one I'm going to calculate it for you. I'm going to debit equity compensation. Equity compensation. I credit ordinary shares because I'm issuing ordinary shares, share capital. Now let me calculate it. Yeah, only for the last one, But for the first and the second, I believe you are going to do it for me. This one is 1,000 minus 24 minus 17 minus 6, 953 times 500 times 30. I'm getting 14,295. 14,295. 14,295. That is what is here. The last year, 14,295. That is what is there, 14,295. But I believe you are giving me the other one, so that you give me the journal entries. Examiner wanted journal entries, but more so you are first required to compute this so that you give us those journal entries. Those journal entries, examiner required, show the journal entries. Journal entries is to which account are you going to debit? Here we are going to debit either staff cost or P&L, or we debit expense. Remember, this is an expense, therefore it has many names. I can say debit P&L, debit staff cost, debit and expense account. It is many names there, but the effect is just one. The effect is just one. I believe you are filling the blank spaces there, so that you also say, I am from FR class. I'm from FR class. Then examiner says there that explain how your answer in C1 above would be different if the employees had the option to be paid the cash equivalent to the market price of the shares vested. Now, examiner is just asking, suppose it was a cash settled. How would you calculate that? Suppose it's cash settled. This is an equity settled. Suppose it was cash. Then number one, listen very carefully. Number one, you will measure the fair value at each reporting date and on settlement. If it is cash, you will measure the fair value at each reporting date. Like you can see here, we use the fair value only one. But if it is cash, then you will measure the fair value at each reporting date and on settlement. You will measure the fair value if it was cash. Then number two, if it was cash, then the employees will get cash, which is based on the fair value at the reporting date. The employees will get cash, which will be based on the fair value of the equity instrument at the reporting date. Those are what the examiner wanted. Number one is that if it is cash, you will measure the fair value at each reporting date. That is number one. Then number two, the employees will get cash, which will be based on the fair value at the settlement date or at the vesting date, the fair value. They will get the cash, which will be based on the fair value at the end of the year. If examiner is in simple terms, just asking the difference between equity and cash, the difference between equity and cash. Now I can see that our time is moving very fast. Therefore, we cannot move beyond there. We cannot do any other question. Let me give you some of questions that you will attempt. You will start with November 2015. There is a question there. You go to May 2016, November 2016. These are some of questions. We look for them. You go to May 2017. This one we have done it. December 2017, and May 2018, and November 2019. Then we have November 2020. These are very common topics, therefore don't underrate it. Very common. You go to after this, you go to April 2022, April 2022, then August 2022, then lastly December 2023. These are very common topics. It has a lot of questions, therefore you go and do them. Wherever you get a problem, I gave you my number. You can just inbox me, or you can just call me and inquire for any clarification Therefore, we shall stop there. We meet next. We are going to the new topic, which is employee benefits. But you need to attempt all these questions for your benefit. You do them. Where you get a problem, you just let Mwalimu know. Thank you for your time. Be blessed. Let's meet on Friday, God willing, as we continue with the same idea. Thank you. Bye-bye.